For as long as people have been investing, there's been one massive debate. Is the stock market a perfect, logical machine that you can't possibly outsmart? Or is it a flawed game, full of glitches that a clever player can exploit? We're going to try and solve that puzzle. So let's just get right to it. Do you think you can do it? Can you, year after year, pick the winners and beat the average? It's a simple question, right? But the answer? Well, the answer is an incredible story that takes us to the very heart of how finance works. All right, to get started, we need to look at this really powerful, beautiful idea that for a long time seemed to have everything figured out. It's the theory of a perfect, flawless market. It's called the efficient market hypothesis, or EMH for short. And the core idea is pretty simple. At any given moment, a stock's price already reflects everything that is publicly known about it. The good, the bad, the ugly. It means every price tag is always correct. There are no secret sales, no hidden bargains. Now think about what that really means. If today's price is already right, what could possibly make it change tomorrow? Only one thing: brand new, completely unpredictable news. And if the news is unpredictable, then the price movement has to be too. It's what they call a random walk. The theory actually comes in 3 flavors, each one a little bolder than the last. You've got the weak form, which says you can't beat the market just by looking at past prices. Then there's the semi-strong form, which says you can't win by digging through public reports either. And finally, the strong form. This one claims that not even secret inside information can give you a lasting edge. So here's the bottom line. If this theory is true, then all that time spent trying to find undervalued stocks, what the pros call searching for alpha, it's basically a waste of time. It's a fool's errand. The theory says your best move is to just buy a slice of everything through an index fund and call it a day. But, like any perfect theory, it eventually ran headfirst into the messy real world. And when researchers started poking around, they found that this perfect machine, well, it seemed to have some very strange, very persistent bugs. And this is the question that just blew the whole debate wide open. What if the code isn't perfect? What if there are ghosts in the machine? Researchers started finding these strange patterns. They called them anomalies that just shouldn't exist if the market was perfectly rational. The first big glitch they found was the value anomaly. For decades, it turned out that boring, cheap stocks, the ones with low price-to-earnings ratios, have consistently outperformed the exciting, expensive growth stocks. In a perfectly efficient market, that just shouldn't be happening. And the glitches just kept popping up. They found the size effect, where smaller companies tended to beat the big guys over time. And then there was this really weird one: momentum. It turns out that stocks that have been winning just tend to keep on winning for a little while. And that flies directly in the face of that whole random walk idea. Now, faced with all this contradictory evidence, you'd think the defenders of the perfect market theory would throw in the towel. But they didn't. Instead, they came up with a powerful counterpunch. They argued these weren't glitches at all. And their argument was honestly pretty genius. They asked, what if these aren't glitches? What if they're features we just don't understand? What if those higher returns aren't free money, but simply a payment for taking on some kind of hidden risk that the old models just weren't seeing? This gave us the famous Fama-French Three-Factor Model. It basically said, look, risk isn't just one thing. Of course, there's the overall market risk. But small companies, they're riskier than big ones. And those value stocks, they're often cheap for a reason. They might be in financial distress. So you're not getting a free lunch. You're just getting paid extra for taking on extra danger. Suddenly, the anomalies started to look rational again. But just when it seemed like rationality had been saved, a whole new challenger stepped into the ring. And this one took aim right at the heart of the entire theory: the idea that investors are rational in the first place. Enter behavioral finance. It said, let's get real. The investor in those old models is a perfect logic machine. But real investors are human. We're driven by fear and greed. We take mental shortcuts. We follow the crowd. We're messy and predictably irrational. Let's go back to that weird momentum thing. Why do winning stocks keep winning? Well, behavioral finance says it's because of us. We see a stock going up, and we pile in. That's herd mentality. We overreact to good news. We hate selling our losers, so we hold on too long. All these human quirks create trends that have absolutely nothing to do with a company's underlying value. Okay, so now we're stuck, right? On one side, you have this idea of a perfect, rational market. On the other, a chaotic mess driven by human emotion. The newest thinking says, what if it's both? Welcome to the adaptive market hypothesis. And here's the big idea. Stop thinking of the market as a machine that follows the laws of physics. Start thinking of it like a biological ecosystem governed by competition, adaptation, and survival of the fittest. It's not a clock, it's a jungle. This one idea changes everything. A machine has fixed rules. It's either efficient or it's not. But an ecosystem, it's alive. It's always changing. Under this view, market efficiency isn't a permanent state. It comes and goes in waves. Think about it like this. An opportunity pops up, like a new food source in the jungle. A few clever investors discover it and start profiting. But then, others see their success and they all pile in. The competition gets fierce, and pretty soon, that easy meal is gone. The market adapts. This totally explains why some of those anomalies, like the size effect, have gotten weaker over time. The secret got out. So we've been on quite a journey through all these competing ideas. Where does that leave us? After all this debate, what's the final verdict on whether you can actually beat the market? Okay, here's the scorecard for today. That strong form? Yeah, that's pretty much rejected. Insider trading is illegal for a reason. It works. The weak form? For the most part, it holds up. You're probably not going to get rich just by looking at charts. But that middle ground, the semi-strong form, that's the real battleground. It seems the market is highly efficient, but not perfectly efficient. So what are you actually supposed to do with all this information? Well, for most people, the original advice still holds. Low cost, passive investing is probably the smartest game to play. Beating the market consistently is possible, but it's incredibly hard and very, very rare. And crucially, you have to remember that because the market adapts, no single strategy is going to work forever. They all have their seasons. And that leaves us with one last question for you to think about. Do you see the market as a static puzzle, one that has a single correct answer if you're just smart enough to find it? Or do you see it as a powerful, ever-changing river that you can't solve but can only learn to navigate? How you answer that, well, that might just define your entire philosophy as an investor.